So what if the biggest risk to the market right now isn't the stuff we talk about all the time, like AI or geopolitics? What if it's something quieter? Something that's been hiding in plain sight for decades? Well, today, we're going to pull back the curtain on a really subtle but absolutely massive shift that's happening in the global financial system.
Because let's just be honest with ourselves, things have felt off lately, haven't they? A little weird. And you're not going crazy if you've been wondering why everything feels so contradictory. Why does the market feel like it's suddenly playing by a whole new set of rules that, nobody gave us the manual for?
To get a handle on the old rules, let's talk about a guy we'll call Dave. Now, Dave's been trading for just a couple of years. His portfolio shot straight up, he made a killing on a meme coin, and now his confidence is, well, it's through the roof. Look, in the greatest bull market in history, everyone's a genius, right? Dave is that market. He was running on pure confidence and incredibly cheap money. But that whole era is ending, and investors just like Dave are about to get a very rude awakening.
Okay, so let's start by looking at the symptoms. What exactly are these puzzles we're all trying to piece together in this strange new environment?
It's this whole collection of signals that just don't make sense together. I mean, mortgage rates are so sticky, they just refuse to come down even when we get good news. The stock market has these sudden, really violent drops that seem to come out of absolutely nowhere. And then you hear the Federal Reserve talking about maybe easing up, but for regular businesses and people, money still feels expensive and just hard to get. Now, you could probably explain each of these away on their own, but when you look at them all together, they just don't add up.
So here's the crucial point. If you're only looking at the Fed and Washington for answers, you are looking in completely the wrong place. The real story, the source of this entire glitch, it starts thousands of miles away, in Tokyo. It's been the financial duct tape kind of quietly holding the global system together for 30 years, and that tape is starting to peel away.
To really get why, we have to understand how Japan became the planet's central piggy bank, how it became, for all intents and purposes, the world's ATM.
So let's do a quick rewind. After their massive real estate and stock market bubble burst back in the early 90s, Japan entered what we now call the lost decades. Just think of an entire economy hitting the pause button for 30 years straight. To fight this stagnation, the Bank of Japan tried everything. I mean, they cut interest rates to zero, then they went below zero, and finally around 2016, they introduced this policy called yield curve control. You can think of it as basically a promise to the market. We will print as much money as it takes to superglue our interest rates to the floor.
Now put yourself in their shoes. If you're a giant Japanese pension fund or an insurance company, and your own government bonds are paying you literally 0%, what are you going to do? You go shopping overseas. And this kicked off a multi-decade global shopping spree that turned Japan into the world's largest net creditor nation. In simple terms, they became the ATM for the rest of the world, just dispensing this torrent of cheap money into stocks, real estate, and government bonds all across the globe.
And this created a really powerful system-wide phenomenon. You could almost call it a glitch in the matrix that for decades provided what felt like free money.
It's called the yen carry trade, and the logic behind it is deceptively simple. Imagine you're a massive hedge fund, right? Step one, you borrow, let's say, 1 billion Japanese yen at basically 0% interest. Step two, you immediately convert all that yen into US dollars. Step three, you use those dollars to buy a super safe US Treasury bond that's paying you, say, 4% interest. And step four, well, you just pocket the difference. It was the ultimate no-brainer trade, and it was happening on a scale of trillions of dollars. And that just illustrates the massive scale of this thing. The yen carry trade became one of the single biggest sources of global liquidity. And it wasn't just for safe stuff like treasuries. Oh no, this cheap money flowed into everything. Tech stocks, real estate, emerging markets, you name it. It was like the entire global market was connected to free, high-speed Wi-Fi coming directly from Japan. But here's the problem with a system that's running on a single Wi-Fi signal. What happens when someone suddenly changes the password? Well, that's exactly what we're seeing right now. This is the great unwinding.
You see, this entire trade, this whole global architecture, was built on one single assumption, that Japanese interest rates would stay near zero forever. And then in 2024, that assumption absolutely shattered. The Bank of Japan ended yield curve control, and then they raised interest rates for the first time in 17 years. In an instant, the password to the world's free Wi-Fi was changed.
In the market's reaction, it wasn't slow or theoretical. It was immediate and it was harsh. The moment Japan hiked rates, all those traders who had been using that free money suddenly had to unwind their positions. Global markets got spooked. The S&P 500 dropped, and Japan's own stock market, the Nikkei, plummeted. It was a crystal clear signal that the game had changed. Because when Japanese rates start to rise,
the math of that carry trade completely flips on its head. It's no longer free money. In fact, it becomes a liability. So that massive, massive flow of capital that poured out of Japan for decades, it's starting to reverse course. The money is starting to come home. This whole process is called repatriation. And believe me, it's one of the biggest, quietest threats in the markets today.
So, why does a financial trade unwinding in Tokyo matter to you, your mortgage, and your investments here? Well, let's trace the ripple effect.
You know, you don't have to take my word for it. The legendary investor Ray Dalio puts it perfectly. He says the bond market is the backbone of everything. It's like the source code that determines the value of every other asset. And what we are watching right now is a real-time event that is reshaping that very backbone.
Okay, and here's a really critical distinction that most people miss. We are all obsessed with what the Fed is doing, but they really only control short-term rates. The long-term rates, the ones that truly matter for things like mortgages and how we value stocks, those are determined by the raw, powerful forces of supply and demand. And that's exactly where our story comes right back into focus.
You can see how this all builds into a powerful domino effect. It starts right here. Japan, one of the biggest buyers of U.S. government debt, starts to step back. That's the first domino. Because they're not buying as much, the U.S. has to offer higher interest rates, higher yields, to attract new buyers. That's the next domino. And those higher rates are what keep your mortgage stubbornly high. They also squeeze stock valuations, hitting the very assets that guys like Dave piled into. And finally, they make it more expensive for companies to borrow, which slows the whole economy down. See? It all connects.
And this brings us to the final and maybe the most critical idea in this whole story, the nature of these quiet threats.
There's a reason you're not seeing this plastered all over the news every single night. It's complicated and requires a bit of patience and nuance to really get it. Cross-currency basis swaps doesn't exactly trend on social media. People want simple stories about inflation or AI, not the complex plumbing of global finance. But that plumbing is everything. Think of it this way. Global liquidity, a huge chunk of it from that carry trade, is like the oxygen in the financial system. For 30 years, we've basically been breathing enriched air. Now that oxygen supply is tightening, and the cost of money, the cost of breathing is going up for everyone, everywhere.
And that is the ultimate takeaway here. The loud threats, the ones everyone is shouting about and debating constantly, are usually already priced into the market. The real risks, the ones that can truly change the game, are structural, they are quiet, and they are so often hiding in plain sight, just waiting to catch overconfident investors completely by surprise.
So I'll just leave you with this one question. The market seems to believe this simple story, that the Fed cutting rates will fix everything, and that some foreign buyer will always be there for our debt. But what if that's just not true anymore?